Hello and welcome. Moss Adams is pleased that you joined us for today's session 990T, Recent Lessons Learned. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters, Tracy Paglia and Lauren Haverlock, both partners here at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Tracy to get the presentation started.
Wonderful. Thank you so much. And thanks everyone for joining us. We had multiple requests to do basics of the unrelated business income and what's new with 990T, so we're thrilled that you're here with us today. We're going to be going over an unrelated business income overview just to make sure we're all on the same page when it comes to what is UBI, what isn't UBI, how to find it, how to quantify it. We'll talk about common sources. We'll go into a little bit of expenses, but we're waiting for more guidance in that area. We'll talk about recent changes and especially the siloing and the NOL rules that keep messing with us with carrybacks and carry forwards. And if we have time, we'll do logistics and resources. But we really wanted to take questions from the audience as we go, and we've left some time at the end as well. So if you do have any questions for us as we're going, please put them in the Q&A box. Lauren and I will do the best that we can to address them as we go. We know we always have more questions than we have time for, but we will do the best we can. So we'll kick it off with a polling question. What do you hope to learn most about in this session? Understanding the basics so I can apply concepts to different activities of my entity, digging in more to the specific exceptions and exclusions, figuring out how recent changes to UBI impact my organization, or all of the above. So in order to get CPE credit, we need to have you answer, and we also know where to spend more time in our presentation. We like to adjust to what the audience is looking for. So we'll give people a couple minutes here. So Lauren, any words of wisdom as we kick off into our UBI basics and exceptions while we're waiting for the poll?
Oh gosh, I mean, one of the things that always gets me in this is that there's the rule, and then there's the exceptions to the rule, and then there's the exceptions to the exceptions with their adjustments and nuances. So really, anytime you're evaluating UBI, you kind of need to create a small flow chart for each of your source of revenue. And so when we speak about it in aggregate, it can be a little confusing. So I think, thinking about it individually and how it applies to your organization and creating that kind of flow chart's always something in my head that gets me through that analysis of UBI.
Mm-hmm. Oh, totally agree. All right, so we have our results here. We've got all of it. So, hey, we picked some good topics then. It's 62% of the results, and the others receiving votes as well. So with that, we'll kick off into what is unrelated business income. And I always like to start with the definition that's in the code because it gives us a lot of great opportunities to kick stuff out that otherwise you would think is unrelated business income before we even get to the exceptions or exclusions in the code or that are written into the code. So when I look at Section 513 of the code, which defines our unrelated trade or business, I first noticed that it said it has to be a trade or business, and the conduct of it has to be not substantially related to the exempt purpose. So I have a Venn diagram coming up that puts this into a picture, but that tells me if we can say it's not a trade or business, or it is substantially related, then it is not an unrelated trade or business, and therefore isn't subject to tax. The other piece I like to point out here is this is an often discussed misconception. In the code, it says, aside from the need of such organization for income or funds, or the use of it makes of the profits derived. Basically saying, it doesn't matter how you use the money. Had a lot of people over the years say, it can't be taxable because I'm using it all for my charitable purpose. That doesn't matter. The service doesn't care how you use the money, so to speak. They care about how it's being earned. So that's where we focus our time and attention is the activities that are happening that's generating the unrelated business income. So here's the Venn diagram that puts into picture what the code just said. Is it has to be a trade or business, it has to be regularly carried on, and it has to be unrelated to the exempt purpose in order to be unrelated business income. So I kind of call this three legs of a stool. And if we can kick out one of the legs, we don't have unrelated business income, and you can earn all the money you want, and it's not going to be taxed. So to be a trade or business, you have to have a profit motive. Now, most people would agree you're not going to go into a trade or business if you're not going to make a profit. But sometimes you have loss activities that generate losses year after year. And the service has said in rulings and the courts and cases that you can have losses, especially in a startup situation, or if you have other good reasons, evidence that you do have a profit motive, even though you've generated losses for a number of years. So if you do have an activity that you think could be a trade or business, but it has a history of NOLs, have you done something to change the way the program's being operated? For example, if you have an Airbnb, one of my schools in an acquisition inherited a bunch of Airbnbs. That's going to be unrelated business income just on the surface of it because it's providing services and temporary housing. If it's losses year after year, have you put a management company in place? Are you advertising it differently? Have you done your pricing differently so that you have changed what you're doing in order to make it profitable? If you want more detail, you can look at the hobby loss rules. There's a whole bunch of cases out there that talk about a lot of horse racing and raising of horses and farm activities that people were claiming were taxable, should be loss allowed activities. And the courts agreed or disagreed based on a number of factors. So you'll want to go look at that case law if you're trying to make the argument. And you're going to look at your net position before depreciation or charitable contribution deduction. So you still might have an overall loss due to depreciation, but if you have profit before that, it could often fall into the trade or business bucket. Now, the IRS goes back and forth on this. If it's a loss one year, they're going to say there's no profit motive. If it's profitable the next year, they're going to say it's a trade or business. So this is something that you need to track and stay consistent on. The next is regularly carried on. So we use this all the time in the exempt space, especially for fundraising activities. So you're going to look at the frequency and continuity of the activity. If it's sporadic or infrequent, it's not going to be regularly carried on. And you're going to look at it in relation to similar commercial activities. So let's say we're selling Christmas trees, right? The Boy Scout troop is going to sell Christmas trees. If they're only selling it from Thanksgiving to Christmas, that would be considered regularly carried on because no one else is selling Christmas trees. It's pretty much outside of that window. But if you have a theater that is having a gala and you have advertising at a program that's in paper, it's just for the participants there, it's not put on the internet, you're only doing it once a year, that would be advertising. And it would be not regularly carried on because it's just once a year when you look at advertising in relation to other commercial advertisers. The third leg of the stool is it's unrelated to your exempt purpose. And I love this factor because we use this one all the time to throw stuff out that you otherwise would think is unrelated business income. And the key piece is it does not contribute importantly to the exempt purpose, and there's no substantial causal relationship to the achievement of the exempt purpose. This isn't the activity itself, not the revenue, right? We're talking about the activity. So I do a lot of work in higher ed. So if we can get students involved in something that looks like it should be unrelated to the educational purpose, but students are getting real life experience or are part of the program, we can get almost everything included as substantially related to the exempt purpose and therefore not unrelated business income. I had a school that had a bed and breakfast because they acquire property that's contingent to their campus. And so they were running that bed and breakfast, which looks a lot like it's unrelated to the educational purpose, except if you get marketing students involved and accounting students involved and hospitality students involved, you've created a real life lab. And so there's an exempt purpose to that activity now, even though it's in direct competition to the bed and breakfasts down the street that would be a taxable entity. So next thing we have to look at here is the size and extent of the activity. So another example would be an ag program that has a herd of cows. And they need to have the cows as part of their program, and the cows need to be milked. So you have 200 head of cattle that are needed for this ag program. The school realizes how much profit there is in selling the meat and selling the milk and all the byproducts, and decides they're going to expand the herd to 500 head. That's purely a money play. That's not contributing to the exempt purpose. So the size of the program has expanded beyond what would be allowed to be claimed as related to the exempt purpose. Another tangent of that is the milk that is sold from the cows is just a byproduct of an exempt purpose and is not taxable. But if you then sell it or you yourself produce it into ice cream, you produce it into cheese, you're doing all this extra work. Unless the students are involved in that, that is going to be beyond the size or extent of the exempt activity. Exploitation of exempt activities we often see with use of intangibles created by the exempt organization. So their name, their reputation, their mailing list. We can make the argument that some of that's royalty, but if it's being sold, often that will result in an exploitation analysis that needs to be done. And finally, we have dual use property. Just because you have a field house that you're using for your exempt activity doesn't mean it's all exempt. If you're then renting it out for weddings, corporate events, family reunions, things like that that aren't related to your exempt purpose, you have a dual use facility, and we have to split the expenses and capture the income that's unrelated. So to bring that piece to a close, it has to meet all three of those legs of the stool in order to be unrelated business income. So Lauren, I'm going to turn it over to you for exceptions and exclusions. Ooh.
And if it does meet all three of those, then, we have some complexities in the fact that it's not necessarily immediately UBI taxable income. There might be some exclusions and exceptions that these fall into. And so I'll talk through some of the common ones that we see. We've lumped together real property rentals and interest, dividends, royalties, gains on sales to kind of this particular slide, because these are key exceptions and exclusions that are maybe a little bit, they're still considered active trades or business, but they're not considered unrelated business income because of that a little bit more passive nature, right? They're specifically excluded from taxable income for the most part. Now you'll see that yellow caution sign, and we'll get to that in a second. If any of these types of revenues are essentially, there's debt used to acquire the properties, if they're leveraged type assets, in terms of that interest, if you're buying investments on margin, if you have rental income from property that has a mortgage that's tied to that acquisition debt, then that there could be UBI implications in that sense. But we'll put that aside for a second. What we'll first talk about is rental income. So rental income is excluded from UBI typically, with a couple exceptions depending on the type of an organization. So if you're a social club, if you're a VIBA, just don't listen to this part about the rental income, and you have your own set of rules in those cases. But generally, rental income is excluded from UBI with a couple exceptions. So if there's personal property tied to that rental income, or there are significant amounts of services tied to that rental income, that disqualifies this exclusion. What is personal property, what's significant in terms of the personal property. So if there's personal property connected to your rental income and that personal property accounts for more than 10%, if it's less than 10%, you don't have to worry about it. If it's more than 10%, then between 10 and 50%, you would have to break out that rental from the personal property from your rental income, and that portion of that rental income would be UBI. If personal property, if you're renting out, real property and personal property, and it's more than like a 50-50 split, then in that case, it'll taint the entire rental income from that real property. And then that entire amount could be taxable to the organization. So that wouldn't be excluded from taxable income. So that's one area to consider, is if you have rental income and there's personal property connected to that rental income, you would have to assess how much of that is in that situation occurring, and that could impact whether there's a portion of that that's UBI. Additionally, I mentioned personal services. There should be no substantial personal services provided with that rental property, and how that's defined is that those personal services are more for the convenience of the occupant, not the organization that's providing the property. So the renter, if you're the organization and you're receiving that rental income, you can provide certain services that are, that are beneficial to your organization. So that would be, some basic cleaning services, janitorial services. But if it's stepped up a little bit more, if you're providing a lot, potentially food and beverages connected to that rental property, that rental, if you're, providing AV services, that might taint your rental income being part of that exception. Additionally, if that rent is from a controlled entity, if it's from a controlled organization that's a taxable organization, or for which that rent is a deduction that reduces taxable income, you'd have to take a look at that as well. And finally, the last thing, and one thing that can be kind of tricky, is that if the rental income is tied to profits from that. So if the rental income is tied to a net profit, then that could taint that rental. That would taint that rental income as well. That rental income would be UBI. So again, as noted, exception, but exceptions to the exception. So you really have to look at all of that rental income and see what kind of services are you providing, what other type of properties along with that services, making sure that that's true. The rental income is not tied to any profits or anything. Those are going to be the most important factors with rental income. Interest, dividends, royalties, gain on sale, again, generally considered passive unless it's debt financed. It's coming from a controlled entity. Again, just like with the rental property, if you have a subsidiary for-profit organization and that organization is paying interest, maybe you have a loan in between, that subsidiary for-profit entity is paying interest to the nonprofit. That interest income, generally interest income is not UBI, but that could be taxable to the organization. Same thing with royalties. I do want to also pause on royalties again. If it's a passive royalty that you're receiving, that's fine. But if there's potentially services tied to that royalty arrangement, certain sometimes mailing list rentals could have that issue, or other mailing list royalties from mailing lists or lists of that nature, there might be UBI implications there. So with that, I want to stop and then pause really quick and say debt financing of all of this type of all these all these income types. If it's a debt finance, there's debt tied to the asset for which there's rental income, interest income, dividend income, that type of passive income flowing through. You would have to analyze the portion of that income that's tied to that debt financed property. And you'd look more at that acquisition debt. So any type of debt that's kind of incurred to purchase the property or because of the purchase or improvement of property, that would taint the income that's generally excluded. So there are a couple more. So that's not it. That's not our only exclusion that we have. There are some additional exclusions as well, and I want to highlight these just to kind of show you, generally speaking. Go through that three-pronged test, you find that it's not related to your organization's exempt purpose, that it's regularly carried on in its trade or business. Two that I want to focus on is there's a volunteer exception. If that activity is conducted primarily by volunteers, then that would exclude that UBI. There's a volunteer exception that would exclude that income stream from being taxable. Same thing with a lot of organizations maybe provide something for the convenience of their members. One thing I think about is in the hospital or the higher education space, there might be a gift shop, there might be a convenience store on campus. A university, its tax exempt purpose isn't to run a convenience store, but providing that benefit to your members, providing that ability for them to stop in and purchase toothpaste or drinks, that's for their convenience. And so that would exclude that revenue stream from taxable income. Some other common ones that we see would be a thrift shop exception that's connected to sale of donated goods. So for any type of organization out there, a thrift store that receives contributed assets and then sells that would be excluded from UBI. A lot of times there's a lot more factors that go into that, but potentially there's job training that's associated with those thrift stores. But if you're selling donated goods, that would be excluded from UBI as well. Some other things that we see again are sponsorships. So sponsorships and advertising is a tricky area in the UBI world. If you have advertising income, advertising is considered taxable income. So that's a time where you would receive money as an organization and allow somebody to advertise online, in a stadium. An advertisement is kind of a solicitation for somebody to buy or somebody to use your services. But a sponsorship is a little bit different in fact that the sponsorship is a contract, a qualified sponsorship is a contract that there's no substantial return benefit for that payment. Now, what does that mean in terms of what's a sponsorship? What's a substantial return benefit? We think about organizations and facilities, university. I think right here we have the University of Iowa. Is that correct? Is that?
No, Idaho.
Idaho. Okay, I can't see you.
I know.
University of
I took a picture when I was there.
of Idaho, and that they have, I think their facility is called, Tracy, the AT&T Park or arena, something like that.
No, ICCU is their new basketball arena. So ICCU is a local credit union.
Right, and so that credit union paid the university to put its name on that facility, and that naming right, that ability to have that name on there isn't advertising. It's specifically a qualified sponsorship, so that would be excluded from taxable income. But if there are banners all over that say ICCU, that's what you want, use our services, that would be advertising that would taint that qualified sponsorship, and that could make it taxable. So additionally, you'd want to make sure there's no other types of services that are provided in terms of that sponsorship. I've seen for some of our theater clients, they might have a sponsor, but they're required to do something for that sponsor. So they're required to put on events or host receptions for that sponsor. And that would take that qualifying sponsorship out of that qualifying area, and it would move it there. If there are significant services to be provided along with that, it would taint that sponsorship. So couple other items we have here are research that's used by the public. And then, if you have organizations that have a county fair or trade shows, public entertainment activities that normally would be UBI, in these situations they wouldn't be. But we're just scratching the surface of some of the exceptions and exclusions. There are a lot more that we could go into, but that's some of the significant ones that we see. And with that, we'll pause for a poll, and any questions that we might have that Tracy might have come up as a result that you want to address here as we go through that poll.
So let's advance the slide there to get the poll going first, and I'll ask you a question.
Sure. I think I pushed it through. How many, this is kind of a preview of what we're about to talk through next. How many partnership investments does your organization have? And if you're not part of an organization, maybe what you've seen, or you can just put none.
So, Lauren, we often see our clients have extra office space. And so can you think of some situations where the subleasing office space or letting another organization use it for a fee would or would not result in UBI? Kind of how would you evaluate that?
Yeah, I do see it as a trade or business for which you would want to evaluate UBI. So it's you're doing that to make money, although you're really just trying to recoup an expense, in terms of your lease expense. But there's a motivation to make money off of that activity. It's regularly carried on. It's not related to your exempt purpose. So you would take a look at that rental income and those exceptions there. If that is a pure office space, if it's, you're not renting AV, desks, facilities, it depends on kind of how that's structured, then I think that could be excluded. But you'd want to see what types of services you're being provided. I mean, the IRS has said that providing a hotel, hoteling spaces or allowing hotel services to somebody wouldn't be considered an excluded. It would be taxable income. It's not an excluded rental. It's not considered rental of real property. So a sublease, you might want to take a look at what's being provided as part of that sublease to that person that's in that space. Is it? But I don't know. I'm thinking through it and I'm like, I wonder. I'm not sure. You might just net nothing, and that might not be a reason to worry about it being UBI. So you might want to just, in theory, report it as taxable income as UBI, and then net off the expenses against it, and that could be that situation. Could be something to do there. So I'm thinking through it, and I'm thinking that the IRS has said that leasing out a parking lot could be taxable income. To parking lot rentals are taxable income. So I'm not sure how a sublease of space would meet that.
Yeah, most
Have you
of the
been
time
through
I
an
see
exam?
Not for an oh wait, yes, a number of years ago. But I usually find most of the subleases that I find are at cost. Usually there's not enough markup, and or it's been like an occasional use of office space type thing. So we've made the argument that it's not regularly carried on because it's only done 4 times a year or something like that. So totally depends on the facts and circumstances. But more often than not, I find there's just not enough. There's no spread. They're just passing through direct costs. So
it doesn't even meet that trader business. So you don't even bring it.
Yeah.
No. So I guess that's a good.
That's why I like
way,
that stool.
Not taxable. Any other questions before?
We should probably move on. We've got more content to go through. We're almost halfway through.
Lots of content. All right.
Yes.
So another potential source of UBI that we see are partnership interests, and this also, is something that, yes, you might have a partnership interest as an investment. So it might start from a place of passivity. You're just investing your extra funds to make some money in terms of a lot of the alternative investments we see. But as a partner, that partnership passes through the characteristics of the income to you as a partner. So it's deemed as though you're undertaking that. You would take a look at that partnership activity. And if there's ordinary trade or business that's not related to your exempt purpose, you're investing in a partnership that, has a Chipotle, that would be taxable income to you as an organization, even though you're not running it. So trade or business income from a partnership, as well as if that partnership has debt financed income or income on margin, which we see a lot of times in our master limited partnerships or those larger types of alternative investments, those could be potential UBI sources to you as an organization. Something else to watch out for, though, is S corporations. So we talked about partnerships, but being a shareholder in a corporation that's made an S election, all of the income that would flow through to you as a owner of that on your K1, so you as a nonprofit, that entire K1, whether or not it's passive income, interest income, anything that would typically not be UBI, all of that income that flows through on on an S corporation K1 is taxable to that shareholder of that organization. I think I advanced the slides properly. And then management services or other types of administrative services to unrelated organizations. Potentially UBI from that perspective. The IRS has taken kind of a hard line in terms of if you're providing it to an organization that's technically related to you, it's reported on your Schedule R, it's part of your hierarchy, then that is not taxable. But if you're providing services to organizations outside of your structure, that management service could potentially be unrelated business income to your organization. And then something that we briefly touched on, payments from controlled entities. We talked through that briefly on the rental income and the interest income, kind of that passive slide. Payment, if you're getting rental income, interest, royalties from a controlled entity, again, that's potentially taxable income to you as an organization. All right, so you have UBI. That's okay. You know, we always tell organizations, like, the point isn't to not have UBI. It's to truly address if you have UBI, and then you would pay tax on that net taxable income. So the allocation of expenses is really important. And once we move to the 990T, once we move to that UBI section, we're operating in the corporate tax regime. So there are a lot of other considerations that we need to have in terms of allocating those costs. It's not necessarily that you just kind of take a portion and just guess what it would be. You would really want to create a methodology for all of your UBI revenue that tracks and has factors connected to it. So the types of costs that are allowed to offset income are costs that are connected, that are considered proximate and primary to the production of that UBI. There is allowed an allocation of costs that are kind of more administrative in nature, or costs for dual use facilities. So a facility that's used both for for-profit and or for unrelated and related purposes, but those allocations should be reasonable and they should be tied to a factor. You're probably not going to have that same factor year over year. I've gone through a couple exams with the organizations that had these types of dual use facilities, and the IRS that representative didn't like that the factor, the space, the time was comparable year over year. They wanted to see, especially when it came to like the administrative costs, like the CFO or the controller or the administrative allocations. They wanted to see time cards. They wanted to see, and when I said that doesn't really exist in these types of organizations, they wanted to see contemporaneous documentation. So did that organization have a memo where the accounting department said, we spent X amount of hours this year, our estimate, working, and that's kind of how we allocated that overhead costs. So if you're allocating overhead costs, that factor should be evaluated annually and documented contemporaneously. So that's something to note. Now, if you have losses from your activities, there are limitations. So if you have an activity if you're undertaking an unrelated activity and you're not sure if there's a trade or a business or there's no profit motive to that, you are limited in those losses that you can carry forward. So you have an activity that's generating a loss year over year and there's no profit motive. You should still report it on your 990T, but you wouldn't generate that loss and create an NOL carryover if it's having consistent losses year over years. And then exploitations of exempt function activities like advertising. There are limitations. You can deduct direct costs against advertising or exploited activities, but you can't deduct more than, if for the indirect costs, you can't deduct more than the revenue on that activity. So there are some limitations to be aware of in terms of that. So again, reasonable, consistent methods. Some of the ones that we see are allocation of space, timesheet, square footage, gross income. Sometimes it might be necessary, but sometimes you've got to take a look. I know that there are some facilities where you might charge your members one amount. So you might charge students X amount for sales. You might charge, non-students or members of the general public a different amount. So you want to be careful for the gross income one, but sometimes it does make sense to have gross income as a factor for expense allocations. And then any other reasonable and consistent method as noted. And then things to pay attention for as noted that this is you're in the corporate tax regime. So there are special rules, there are non-deductible expenses. In the nonprofit world, we were really excited to not worry about the parking tax. So, what parking we provided to our employees. Well, parking is still a non-deductible expense in the tax world. So if you're providing parking benefits to your employees, it's still considered a non-deductible expense. You do have to consider it for UBI, but there are other things like meals and entertainment, other items that might not be fully deductible in the taxable world. Depreciation is not something that we worry about too much in terms of a Form 990, but when you get to the 990T, you should pay attention to the method of depreciation that you're using, especially if you have debt-financed income, because there are particular rules if you're using a different methodology to apply for that. Something else that we see that might not be as known is that charitable contribution deductions. If your organization is making grants to other qualifying 501c3 organizations, that can be deductible in against your unrelated business income, whether or not it's primary and proximate, directly related to that UBI. There are limitations to account for, but it's something to consider. Now you are under the 170 rules, so you might have to get a charitable acknowledgement for that grant and track that in that sense. But it's something that a lot of our organizations find is a really nice benefit that they can get a little haircut off of their taxable income because of. And then state income tax and foreign taxes deductible as well. So with that, I'll pause to see if there are any questions to come that have bubbled up and as we talk through expenses, but if not, we're moving along to recent changes.
And a polling question. So let's see, how do I get slides here? Here we go. Okay, recent changes. Here we got our next polling question. So how many silos of unrelated business income does your organization have? So, of course, depending on who is listening on the call, you could just have one, you could have a handful, 2 to 3, more than 4, or it's not applicable. I also recognize that there are people on this call that serve more than one organization, so this might be a more difficult question. So just pick the one that's most frequent with your client base if you do more than one exempt organization return. So Lauren, a question did come up while we're waiting for the poll. Depreciation, is straight line allowed for depreciation on UBI activities? Can you recap that again for us?
Yeah, straight line depreciation is allowed in the taxable world. I have to kind of think back to my days more focused in the tax world. But you might find benefit from an advanced type of depreciation. I think straight line is the only type of depreciation that's permitted when you have debt financed income. I don't know if you have any thoughts about the debt finance. I think that's a requirement for debt finance, yeah. But otherwise I think it's permitted. I think you just want to make sure that you're using the proper useful life in terms of what the IRS defines as in terms of their useful lives. A lot of times we see startup costs not getting properly amortized. Those are things that you want to take a look at when you have these UBI, these different activities that you have. So a lot of things to consider in terms of the deductibility and whether you need to amortize it. It might be different than your GAAP financials.
Yeah, I often find my exempt organizations don't care about depreciation. They just follow a book until we get into UBI. And then you got to look if it's trade or business, if it's debt finance income, if it's debt finance in a partnership, all these very complex rules. But, if it's line one, ordinary trade or business, the ordinary rules apply. You get to use all the accelerated stuff and tax methods.
There could be a benefit to not doing straight lines if you wanted to take a look at that, to bringing forth those deductions.
All right, cool. So we have our poll results up. So most people say it's not applicable, but the next right behind it is a handful, but not too many. So because of the time, we won't spend too much time on the siloing rules. We'll just introduce it to you, but not go into a whole bunch of detail. Because I think earlier, too, we didn't have a whole bunch of people with partnerships. And that's what a lot of the siloing relates to. So just as a recap, nonprofits used to be like corporations where you kind of throw everything in the soup pot that is taxable and it all goes on one form, in our case, the 990T, and profits offset losses, everything was all together like we're used to, like our individual returns are, like corporate returns are. The Congress came through after this college and university study and said there's a whole bunch of taxable income out there that's being sheltered because you have these huge losses from alternative investments, you have all this profit from advertising, for example, and you're going to net it all together and they don't pay tax and they should pay tax. So that's why Congress came out with this 512A6 rule that was effective for years beginning after December of 17 that said if you have different trades or businesses, you have to treat them in different silos, which has made our lives very complicated over the last few years as we went through the initial law in 17, the notice in 18, the proposed regs in 20. Now we have final regs. So things have kind of settled down. They've reserved some areas for future guidance, but for the most part, effective for years beginning on or after December 2nd of 2020, we are now in the final regulations for siloing. So we're pretty much stuck with what we've got with a few exceptions. So to put it in context, this is what it used to look like. And this is what our for-profit companies look like. This is what our individual returns, for the most part, look like. Is you've got 5 different sources of income here. You mush them all together. And in our example here, we had a net loss for the year of $165,000. You would have reported that on your return, paid no tax, and carried that NOL forward to offset future income. Now we can't do that anymore. For years beginning after December 31st of 17, we now have profit from web advertising, printing services, and conference services that we have to pay 21% tax on. So we have tax of over $70,000. We have a net operating loss of $462,000 that we can only use against investments, and rental income loss of $40,000 that we can only use against investments. We now have to carry it forward, which we have an NOL table that will help you remember the new rules. And it can only be used against those sources of income. So it's much more complicated. And tax planning is much more difficult because you can't just look and say, oh, we have NOLs. We don't have to worry about it anymore. We now have to care if it's pre-18, post-17, how it's siloed. It's very complicated when you have multiple sources. All right, Lauren, I'll turn it over to you for siloing. And
even more complicated if you have investment activities, which a lot of the organizations that we work with do. So if you do have investments, there is an investment silo. So typically you're siloing based on NAICS codes, but there is an investment silo that's allowed. And within that investment silo, you can aggregate qualifying partnership interests, which we'll talk about in just a second, S corporation interest. So we noted that any type of income from an S corp is considered UBI. That gets to go in there, as well as debt financed income. So any of that rental interest, dividends that come from leveraged assets, those leveraged passive activities all can be lumped into the investment silo. So taking a look at that qualifying partnership interest, if you do have K1s, if you are invested in partnerships, when can you lump that in to kind of your investment in your investment silo? You'd want to take a look at, you'd have to take a look at each of those partnership investments and determine, are you a general partner? If you're a general partner, then you have to take a look at each of those partnership activities and potentially put that trade or business or that revenue that comes through that activity into its own silo potentially. But if not, if you're not a general partner, you first take a look at the de minimis test. So that assesses you're looking at your capital interest, your profit interest. And if you have less than 2% of the profit interest, capital interest, you're not a general partner, then you meet this de minimis test, and that K1, all of the income from it, trade or business, interest, whatever's UBI, can go into your QPI and your investment column. If you're above 2%, the next test that you look at is the participation test. Is it you have more than 20% of the capital interest? If you don't have more than 20%, if you have less than 20% of the capital interests, and you don't start significantly participate, you're not a general partner. And another factor in this participation test is you have to also look at some of your related organizations. If you have a supporting org or a controlled entity, you have to take a look at if they own part of this partnership as well in determining if yours 20% or less of that capital interest. So if you and combined with any related organization has less than 20% capital interest, then you could meet this participation test if you're not significantly participating in that activity and you're not a general partner. Then, there was a transition rule that was in place before the final regulations came into play. So we'll just skip over that transition rule because moving forward, if you are more than 20%, if you don't meet these de minimis or participation tests, then you'd use this look-through rule, which then evaluates any indirect interest. A lot of these partnerships have multiple tiers, and so you'd look at those tiers, the partnerships that are owned by that partnership, so the low tiers, sub-tiers, and do those, you'd apply the de minimis and participation test there to see if you can lump those amounts into your QPI. So anyways, there's a lot more analysis that needs to go in terms of siloing your K1s. They're already a bit of work when taking a look at them. And I forgot to advance the slides, so I'm sorry about that. There's a little bit of information on the de minimis test. So there's some stuff that you can read through in terms of when you pull down those slides to kind of, as you're evaluating your K1s, what is the de minimis test? And then the next slide is the participation test. And so Yeah, that's what you would look at with each K1. So for the clients or organizations that have a very big and very robust portfolio with lots of K1s, it can be a little bit of work, but it's usually pretty easy to evaluate year over year. You kind of get the hang of it. So don't change. Don't change.
Yeah, we've had some situations with these multi-tiered partnerships like you're talking about where, you know, we're just looking at the top level, and if it's more than 20%, we're having to drill down through what does this partnership hold, and we need NAICS codes, and we need activities by underlying participation activities. So just as a warning, look at your K1s early, because chances are you're going to have to go back and ask for more information if you own more than 20%. Kind of just rule of thumb.
Yes. So, and that's all we have on Silo. If you have questions on silos, you know, when we go through our Q&A, we can talk a little more about them. But with the responses that we received, I think that this is a good overview. And as we have the final regulations out, it's a little bit easier to assess those. So you know what silos you have. You are now not only are you tracking one NOL, right? Before the Tax Cuts and Jobs Act, tracking an NOL was difficult in and of itself. The NOL rules change. You know, a lot of it's one of those areas that Congress uses to help organizations in times of recession to, you know, have access to an NOL, to be able to carry back an NOL to offset it against prior year income. So tracking NOLs and what their carryover period and carryback period and limitations is a lot of work in and of itself. But now we have a couple different buckets of NOLs that we have to evaluate. So before 2018, the pre-TCJA NOLs, they're not siloed. They were all aggregated together from all of your activities. So currently they can be used essentially in any way possible that you want them to use. But these have a characteristics of there's a 20-year carryover period. So they can only be carried forward for 20 years. They have a limitation. They have a lifetime. They could be carried back at some points for 2 years. And there was no limitation. So you could fully offset your taxable income with your NOL. And we won't talk about alternative minimum taxes, but for the general tax that we all have to deal with, unrelated business income tax, corporate tax, there was no limitation on that. So they're kind of the preeminent NOL. But they do have that 20-year expiration period. After the Tax Cuts and Jobs Act, we had a change, right? So the post-2020 NOLs, that's what we got with the Tax Cuts and Jobs Act. Unlimited carry forward period. That's the last column here. Unlimited carry forward period with no carryback allowed, and an 80% NOL limitation against taxable income. So you cannot fully offset your taxable income in a particular silo with an NOL that's created in that silo. And these are siloed NOLs. So the NOL created after the Tax Cuts and Jobs Act can only apply to the NAICS code for which it was created, or in the case of an organization that you know doesn't have a trade or business but has K1s, that loss generated by the K1s by your partnership investments are stuck kind of with that partnership investment. And so they can only offset future amounts for NOL benefit with the CARES Act, right? This is why one of those things that CARES Act are not, NOLs are not permanent. I don't know if we, Tracy, for a second. The rules for NOLs aren't permanent. So with the CARES Act, if you're thinking, well, I haven't seen a limitation on our NOLs in the past couple of years, it's because we had the CARES Act to kind of help and give us a little bit of a benefit from the NOLs. Can everyone hear me okay? I just want to make sure that everyone's hearing me okay, because someone saw something.
Yeah, there was a minute there.
Okay, Tracy, I think you have a little bit of an echo, so there might be an audio issue for you. Maybe I think you might be maybe mute your computer for a second. So all right. Anyways, that is the NOL stuff. So now NOLs are very confusing. So how do you use them? So how do you use an NOL? Well, you're required to go, you're required to start with the oldest NOL. So you would be using your 2018 pre-TCJA NOLs first. But the way that you would offset them, so how do you apply those to your various silos? You can apply it in any way that's most beneficial to your organization. So that's just something to note as you're using those pre-TCJA NOLs, those kind of NOLs that can be, I like the unicorn NOLs that can be used anywhere to your biggest benefit. Use those first, but you can apply them as you need to against your different silos. All right. Any questions come up about NOLs, Tracy? I know there's a lot to NOLs. There's also this interaction of how NOLs and charitable contribution deductions work when it comes to UBI. We won't dig into that. That's something that your tax professional hopefully can spare you from knowing. But NOLs are complicated, aren't they?
Well, yeah, and we've seen changes in the 990T and what was the Schedule M and is now the Schedule A as the IRS was trying to morph and figure out how should this all be used, because you've got older NOLs that will expire if you use the silo one first, and the silo ones are only allowed against certain income, not all income. So it took a little time. So if you're looking at your 990Ts, starting in 18, 19, 20, we're now filing 21, you'll see it morph. And the NOLs have moved. And sometimes you'll see NOLs on the Schedule A against a specific silo, and then you'll also see NOLs on page 1 of the 990T, and charitable contributions have moved around. So it's been very confusing for all of us. Hopefully it's going to settle down now, and the form that we have for 2021, I would expect to be the form that we have going forward unless the IRS changes something relating to expense allocations.
And there now is a little section added on the 2021 990T that shows the different silos of NOLs and the pre-TCJA NOLs. And that's really helpful in terms of now being able to track that. Something else is not really in this UBI, in a recent change, but something to note, if you're using old NOLs, you've got to have all that, the backup and the substance behind that NOL. So if you're using a 2010 NOL, well, that might be beyond what your retention period is in terms of, keeping the data, the accounting data, the tax data, but you have to have all that backup data to use that NOL, because as you're using that in a current year, the IRS could ask to see kind of the evidence of how that NOL was created and the backup for that NOL, the expense allocations and things of that nature. So it kind of is one of those things that might pull you out of the statute of limitations in a way, and they could disallow it if you don't have that evidence and that backup data for that. All right, so now we're on, I think this is our final polling question. All right. Oh, what would you like to learn in our next session on UBI? So this was a high-level primer, but we can always take deeper dives, and we'd love to hear from you to see what you'd like to hear more about, whether it's walking through the forms, practical reporting tips, diving into the 3 related prongs, case studies, digging into common exceptions and exclusions, or all of the above, please. Or maybe you're good. You don't want to know any more about UBI. That's enough to make you never want to think about UBI again.
Yeah. So while the poll is up, because I don't want to advance the slides and accidentally close the poll, I want to give you plenty of time, we'll start going through the logistics. We've got a couple slides that talk about the 990T and when it's due, and you can take credits and all this stuff. But really what we've learned in the lessons learned part of this thing is e-filing has been just a nightmare. It became required for the 2020 forms, some of them. Actually, I think all of the 2020 forms. I've got the dates on a later slide that you'll see here in a minute once we close the polls. But we are finding right now the IRS is sending back 2019 990Ts that were required to be paper filed. We weren't able to e-file. The code said we had to e-file, but the IRS wasn't ready for it yet. So they didn't start requiring paper filings till due dates after April 15th of 21. So 2019 forms obviously couldn't be e-filed, so we paper filed them, and they went into the railroad cars of the millions of returns that we've all been hearing about that haven't been processed. We're now seeing those 990Ts that were paper filed returned to the taxpayers with a letter saying you were required to e-file. And the response that we've been told to provide is no, we weren't required to e-file. Supposed to write at the top of the 990T something like the 2019 forms were not allowed to be e-filed. Send it back. Don't throw it away because the IRS has returned that paper filing to you. They don't have it in their system. So you have to return the original filed return with a letter and that notice that says we weren't able to e-file, please process. Now, I've had a couple situations where we've gotten the notice, but we haven't gotten the original filed return back. So we've had to print a new copy and have it re-signed. It's not the best because you got a new signature and a new date, but it's better than not returning anything at all because you got to remember it's not in their system because they returned it to you. So that I got it up on the slide here for the particular dates, but we've been seeing a slew of those, which is just a nightmare. So we've talked a lot about federal UBI. If you have federal UBI, you probably have state UBI as well. Not always, because sometimes it could be foreign sourced, but you likely have state UBI. So you really need to be looking through. Once you go through all steps we talked about, use the three-legged stool, use the exceptions and exclusions. Once you get there, you've identified federal. Now we need to identify state. And the decision whether to file a state unrelated business income return is really one to be made by the filing organization because you might want to file if there's a loss so you can capture that loss and carry it forward. You might not want to get on the state's radar, so you might create kind of a threshold that we aren't going to file unless we have X dollar number of tax that's owed because once you get on the radar, you're almost certainly going to be on the radar. So keep that in mind. We also have the issue of state withholdings because a lot of the partnerships that are flowing through unrelated business income could have withheld state. Either they were required to or they didn't ask you if you wanted to opt out, so they just did it on your behalf. Now you have $5,000 deposited with the state of California. Maybe you didn't have to file in California, but maybe it covers your tax liability and maybe now you don't need to file. So it's really something to be evaluated once you have, if you have alternative investments, once you have all your K-1s, or if you have separate silos because your organization has unrelated business income, you figure out what states that income is sourced to, and then decide if you're going to file. Once you get on the radar, you got to expect to stay on the radar and file every year. The other point that I wanted to make is payments. So if you have a 990T and you have tax due, you almost certainly have to electronically file. I don't even think there's the $500 threshold anymore. I think you have to e-file all payments at this point. We do have the estimated tax payment threshold of $500, but the requirement to use EFTPS is here. So you can run to your bank, I believe, and still do like a last-minute transfer if your bank is willing. But for the most part, if you think you're going to have unrelated business income, it doesn't hurt to register with EFTPS, get your PIN, do the setup, because it takes a while. It could take a couple of weeks to get set up, and you don't want to miss that. And as a reminder, the 990T was added to the public disclosure requirements a couple of years ago, so you have to include the 990T with your public disclosure copy of your 990 or your PS, but you do not include all the foreign filings or anything else that doesn't contribute to the calculation of tax. So that's one of the reasons that we attach all those horrible 926s and 8865s to the 990T, because it's not open for public inspection there, but it is if you attach it to a 990. So yes, we have 2 minutes left. Lauren, were there any questions in the chat that we didn't run through that you want to bring up or respond to?
We did have a question that was an interesting scenario to me, and I think there's, again, this is one of those items where you might need more information about how this organization is structured and what type of entity it is. But an organization collects membership fees, and as a part of the membership, they allow people to post blogs. Could that taint that membership revenue? Can it become advertising revenue? Do you have any thoughts on those types of benefits to the members?
So, like you said, it depends on the circumstances. If we have a 501c3 organization that has memberships, like a museum, you look at the rules and decide maybe it's really a charitable contribution, it's not really a service, but then you have this return benefit that they can post a blog. So you've got to do that in the evaluation of the C3. C6s are a little different in their analysis of membership fees and how you classify it as program revenue membership fees. Sometimes we have readership and publications that come along with that. So the long answer, which I'm trying to shorten, is it depends on the organization. If this is a single person, you're allowed to do a blog, and it's just a general add to the information. There's no advertising in there. We might be able to make the argument there's no return benefit there. But if it's a blog or linking to someone else's commercial blog, that can start looking like advertising, could be regularly carried on. If it's a one-off that you're allowing someone to do, it's a different evaluation than any member paying has the right to do a blog. And maybe you have a bunch of them out there. Then you get into the regularly carried on and those that make it look more like unrelated business income as opposed to a one-off, one-time blog, no advertising, probably say that's not regularly carried on and wouldn't be UBI. So to the person who asked the question, you're more than happy to contact us, and we are happy to go through that in more detail. And with that, I think I'm supposed to turn it back to Danielle to close us out.
Wonderful. Thank you, Tracy and Lauren, for a great presentation today. I also want to thank the audience for being engaged and submitting your questions to help guide today's conversation. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. Also, feel free to reach out to our presenters if you have additional questions. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in your console. Finally, here's a link to an online survey for today's presentation. Thank you all for joining our webcast. We hope you'll join us again next time. Take care, everyone.
All right, thank you.